Sometimes I think playing the market is similar to playing cricket. Imagine Glenn McGrath bowling to you, dogged length, on the off stump and swinging away, right in the corridor of uncertainty. You leave the first delivery and then the second and the third and fourth until you get impatient, play away from the body, and very likely end up caught behind. Stock market is presently positioned pretty much the same way, in the corridor of uncertainty. Nifty has been locked in the zone between the 50 and 200-day EMA for the entire past week. Intraday volatility has been high, with elevated chances of getting whipsawed. Following our motto that return of capital is more important than return on capital, we have stayed out, and you will agree, wisely. The indecisiveness of the market was amply illustrated by bourses across the world. Over the last week, main European indices barely moved. CAC, DAX, and FTSE all gained under 1%. Dow and Nasdaq were equally unmoved, again under 1%. In Asia, Japan gained 3% while Shanghai fell 2%, all others being flattish. Nifty, in lockstep, ended at 5,146, having begun the week at 5,139. Globally, stimulus expectations have been punctured by the Fed last week. The earnings downgrades continue unabated. No resolution of European crisis is in sight. Indeed, fresh negotiations are yet to start. Chinese growth remains suspect. No, there isn't a lot to lean on. According to Fitch, the credit rating agency, top 29 globally significant banks will have to raise $566 billion by 2018 to meet capital adequacy requirements. This effectively means that either they have to shrink their balance sheet by $5.5 trillion or retain 3 times their current combined earnings. This prima facie could constrain growth as banks find it difficult to lend to businesses. Almost as a sequel, Moody's downgraded top 15 banks by 1 to 3 notches last week. The list included such venerable names as UBS, Goldman Sachs, Credit Suisse, Morgan Stanley, and Citigroup. Monsoon eventually arrived late. Met offices predicted 96% normalcy. The bookies differ though. They have raised the odds of betting a rupee on normal rain from 50 paisa to 1 rupee 25 paisa, while dropping the odds for deficient rains from 2 rupees to 70 paisa. With food inflation running away, uncertainty of a monsoon can be yet another headwind for the market. In a landmark decision, Competition Commission levied stiff penalty on the cement companies, aggregating 6,300 crores last week. Market stayed unmoved, and the leading cement counters dropped barely 1%, reflecting either a lack of regard for such judgments or abundant faith in the lengthy appeal process. Rupee fell to an all-time low of 57.15 to a dollar, despite Brent cracking to an 18-month low of $88 per barrel, thereby helping reduce India's trade deficit. While headlines lament the plunging rupee, RBI rightly remains unmoved. Percentage Play believes that the weak rupee and falling Brent, along with Pranab Mukherjee demitting office on the 26th, remain the only silver linings for the market reeling under unremitting bad news flow. Evidently, markets lack conviction. Too many unresolved challenges, too little consensus. No time to be adventurous. Quantitative pair fund notched up 3 smart wins last week. We currently carry 2 positions which may need to be rolled over unless targets are hit before the settlement. Percentage Play has tweaked its algorithm for QPF to include a wider selection of pair opportunities going forward. Pairs on the radar for next week are Infosys HCL Tech and SBI IDBI Bank. As expected, Competitive Value Fund remained aloof except buying TCS on Monday as a breakout candidate. The stock flattered to deceive and dropped through rest of the week, adversely impacting our outperformance. We believe the fall is temporary, perhaps a better buying opportunity, especially in the context of the plunging rupee. But one of our quant models indicate a bearish bias for next week. Consequently, CDF is likely to remain in the sidelines unless some compelling opportunity develops in the course of the week. Our quant trading systems are scheduled for launch on our website next week. Percentage Play is excited to help traders with real-time calls based on two of our algorithms. One of these, we call it the Power Swing Quant Trading System, is based on the principle of maximizing profits while taking losses early. The performance so far, despite the difficult market, has lived up to our expectation with a spectacular 30% gain in 1 month, which we are sure will moderate in future. The other system being put in public domain is a rapid fire quant trading system where positions are squared up the next day. Here again, we seem to be on track with 72% winning trades, although average win lags average losses marginally. Please take time off to visit our website to find out more about our quantitative trading systems, a family of thinking trading systems.